In order to maximize our gross profit, we are going to focus on 6 key areas. To help us remember these 6 items, we use a simple acronym, LIFERS. The L in LIFERS stands for lates. The amount of past due customers affects the amount of gross profit that we're going to bring in. More past due customers will mean less gross profit, and fewer past due customers will mean more gross profit. The I in LIFERS stands for idle and service. This is the amount of merchandise that we have tied up either in our showroom that's not generating any income or in service waiting to be repaired before it can make more income. The less amount of idle product we have, the higher our gross profit margin will be. F in LIFERS stands for fees. These are all the extra fees that we can generate and additional revenue items that we can drive into our P&L outside of raw rent. These include things like the club, reinstatement fees, and damage waiver. The E in LIFERS stands for extensions. The amount of free payments that we give away directly impacts our gross profit margin. If we give away more free payments, we'll have a lower gross profit margin. And by giving away fewer free payments, we'll maximize our gross profit. The R in LIFERS stands for rates and terms. The way that we set up new rental agreements directly impacts the amount of revenue that we can generate off of a rental unit over that rental agreement's term. The S in LIFERS stands for skip stolens. More skips means less profit. Now that we've talked about the 6 key areas that we can control, let's see how depreciation is calculated on our profit and loss statements. Here's a quick quiz. We have a brown recliner that has an original cost of $240, a retail price of $499, a weekly rental rate of $19.99, and a total term length of 78 weeks. Which of these items factor into rental unit depreciation? The rental unit's cost factors directly into rental unit depreciation. However, the retail price, rate, and term have no bearing on rental unit depreciation. To calculate the depreciation on a rental unit, we will start with its original costs. In this case, we purchased a recliner with an original manufacturer's cost of $240. Happy's depreciates all of our rental units over 24 months. This is known as straight line depreciation. All of our units begin depreciating in the month that we receive them. In this case, the original cost of this recliner was $240, and this will be depreciated on our P&L over 24 equal monthly installments of $10. So if we have this recliner active or idle in our system, our P&L will be charged for $10 of rental unit depreciation. Our point of sale system will start to record how much depreciation we've incurred on this item. This is known as accumulated depreciation. We also track how much of the original cost is left. This is known as remaining book value, or RBV for short. RBV always starts at the original wholesale costs. In the first month, we will record $10 of rental unit depreciation. All rental units are depreciated regardless of the item's status. Active, idle, service, and loader items are all depreciated on our profit and loss statement every month. In this instance, our accumulated depreciation will increase by $10. Our remaining book value will decrease by $10. You'll notice that the RBV and accumulated depreciation will always add up to the item's original cost. This process will repeat every month, and the unit is active, idle, or in service. So in the second month, we will depreciate an additional $10. Our accumulated depreciation will increase to $20 total, and our remaining book value, or RBV, will decrease to $220. In month 3, we'll depreciate another $10. increasing our accumulated depreciation to $30 and lowering our RBV to $210. In the fourth month, the process repeats and our RBV lowers to $200. This unit will continue to depreciate until it has zero remaining book value or it is removed from inventory for one of the following reasons. The item could be paid in full by a customer. The item could be removed as a stock write-off in the event that there's an inventory discrepancy. The item could be removed because it's unrepairable and we can no longer rent it because of its condition. The item could be removed from inventory because it was stolen by a rental customer. The item could be removed from inventory because it was missing under audit. And finally, the item could be removed from inventory because it was cashed out as a retail sale. When the unit is disposed, we write off any remaining book value and charge that amount to the P&L. If the recliner was paid in full, broken, stolen, sold, or missing, we would take the entire remaining book value of $200 on our cost of goods sold on the P&L. Here's where to look on your P&L to find these items. The largest line item on our cost of goods sold will be rental unit depreciation. This is the amount of depreciation that our store expensed in a given month. Rental unit depreciation is going to be on active, idle, service, and loaner items. Below rental unit depreciation, you'll start to see the different types of write-off accounts that we use. Write-offs for sold units are for any units that were purchased via cash sale by a customer. Write-offs for paid out are for any units that were paid in full. This is typically the second largest line item on our cost of goods sold. Write-offs for stock are typically going to be a smaller line item. Write-offs for stock are going to be for any items that were removed via stock write-off. Write-offs for skip stolen are going to be for any items that were stolen by a customer. Write-offs for damaged or unrepairable are going to be for any items that were no longer rentable due to their condition. And write-offs for missing under audit are going to be for items that we couldn't find while performing an idle inventory. We would expect that to be zero. Depreciation items are booked in the red boxes. We don't use every depreciation line item, so you'll notice that some items like fire loss, internal theft, stolen, or burglary are always going to say zero on your P&L. There are other line items that are booked to our cost of goods sold that are not depreciated. These are actual cash expenses. These include the club expense, which is the amount of our club fee that we remit to benefit marketing. Repairs for rental units to get rental units back into rentable condition. Small parts like washer hoses, dryer vents, and power cords. Vendor credits, which could include any items that are credited for being damaged on arrival to our store or any other reason that a product vendor could give us a credit. And finally, freight. It's the amount of the invoice that we paid for the product to be delivered to our store. All of these line items are weighted based on their percentage of total revenues. These percentages are located directly to the right of the total dollar amount. The total cost of goods percentage is in bold at the bottom of this section. In this example, our store ran a 34.84% cost of goods sold. That means that they had a gross profit margin of 65.16%.